We are going to start the second half of I Survive Real Estate. Enjoy your dessert, and thanks again for coming out tonight. We really appreciate it. And for those of you watching online, if you'd like to make a donation, you can do so by going to I Survive Real Estate. The link's there on the front, as well as the event program. And with that, we'll hand it over to Dad.
Okay, we're ready to get started again. If I didn't, time out. Thank you. If I didn't come by your table, I want you to know there was a good reason, because if I did, you wouldn't even hear my voice at this point. Last year I did that, and I didn't have a voice at halftime. So if Bill hadn't come up with his wonderful lozenges, we wouldn't have had a second half. So I've tried to conserve my voice this time. Once again, thank you guys for coming. It's been a very special evening, and I'm excited about the information we're getting, and we're about to get more of it. We're going to invite Rick Sharga to come up. Rick is probably the most quoted person in our big scope of real estate industry. He's been being quoted for the last 8 years or so, some with Realty Track, most recently from Carrington. He's executive vice president of Carrington Holdings Company LLC, and one of my friends in the business. I appreciate him very much. And he has a black belt in Taekwondo, so I have to really behave myself. And then Sean O'Toole from Foreclosure Radar. Yeah. Oh, got quite the following. You've been promoting yourself out there or what? Sean's a good friend of mine, and we have just spent some time in Washington, D.C. He's the owner of Foreclosure Radar. And prior to launching Foreclosure Radar, Sean was a buyer at the trustee sales steps. And prior to that, he was a he was a computer prodigy in high school. Anyway, we're excited to have both of you here. This will be kind of fun. Rick, let's talk about this new world that we are contending with. Let me find my place here. If you can describe, what is Carrington's business model, basically? That's not easy to do, is it?
No. How much time do we have? Carrington is involved in just about every aspect of the single-family residential real estate business. The company started as a hedge fund back in 2003. Bought a mortgage servicing platform when New Century went bankrupt in 2007. We bought their servicing business, created a property management business after that, a real estate business, a brokerage after that. We're doing mortgage originations now as well. So anywhere from investing in portfolios of loans all the way through selling and maintaining and renting properties, we have a business unit that's involved in it. We have 16 different business units operating under the Carrington family.
Are they all located in California?
The investment group, we have two businesses that manage the investments are in Greenwich, Connecticut.
Okay.
The title business is actually located in Plano, Texas. Everybody else is in Southern California.
Your interest in this space of single-family homes really kind of emerged earlier than most people, it would seem.
Yeah, our CEO had the notion back in 2006. The company invested in pools of subprime loans.
Okay.
Which, as we all know, performed really, really well. So we had a couple of foreclosures. And the business model at the time was foreclose on the property, list it, and then keep discounting it until it cleared. And he had this really, revolutionary thought that maybe we should hang on to some of the properties, rent them for a while, and see how that worked. So that started really back in 2006, and we were renting our own portfolio of properties, build out a network of property managers in about 35 states, which allowed us to subsequently start renting out properties on behalf of Fannie Mae. And we've been the largest rental property manager for Fannie in their tenant-in-place and deed-for-lease programs, probably rented out, managed over 15,000 properties in those programs over the last few years.
Do you think that your business model was viewed by some of these people and, you know, that have joined you and said, huh, because this is new. No, we've not had the size of a player in the single-family arena.
The big shift that we're talking about here is, and this is where you and I reconnected a few months ago, we raised, through our partners at Oaktree, which is another big investment fund, we raised almost $500 million to go out and buy vacant REO properties, convert them into rental units, and hold them for the next 5 to 7 years, and manage those properties as rentals for a couple of reasons. One is that rental units nationally are occupied at 97%, which is an all-time record. Rental rates are going up. We have probably somewhere in the neighborhood of 6 to 10 million displaced potential homeowners who either don't have a down payment, won't qualify for a loan for several years, despite what you said earlier, or have opted to stay out of the market as buyers for the time being. And our extensive research suggests that most people still prefer to live indoors. So, so we see, and you know what, we're really doing on a national scale, or trying to do on a national scale, what all of you have been doing individually for years now. We're trying to provide a place for people to live who either can't or don't want to buy a property right now. The big difference is nobody's done it on a broad-based national scale. This is the ultimate mom and pop, small investor kind of operation. 12% of rental units nationally are single-family units. Most of them are managed and owned by somebody on a local basis. So we're trying to extend it a little bit more broadly.
When you tell me your exit is, let's say, 5 to 7 years out, is that going to be, it's apparently market-driven, you're looking at the tea leaves and saying now's a good time?
Yeah, our model's a little different from many of the other investors that you've seen out there. There was one that this week announced they're pulling out already. Oxif, who purchased 300 properties up in the Bay Area, amazingly enough, didn't get the returns they'd expected because they overestimated the returns. Who knew?
We're really sorry about that.
I bet you are. Especially the San Jose folks are probably really crying about that right now. But
well, were they rewarded though with price increases?
And they were. And so I saw an article today I thought was hysterical. The headline was "Investors Learned the Price of Hubris," however you want to pronounce it. and I thought they didn't learn anything. They just made a healthy profit on the flip.
Just quicker than they thought.
Just quicker than they thought. So our model's a hybrid. We're looking at a relatively low annual return, probably somewhere between 4 and 8% a year, depending on the market, with home price appreciation. So we're very, very selective about, we're looking at the Inland Empire, yes, but we're not looking everywhere in the Inland Empire. We're looking at almost neighborhood level, the way that you guys do. And we're looking at markets we think will appreciate over time. So it is a hybrid model. There are a couple other investors who are out there trying to scale up rapidly, and they're the ones that are kind of screwing up the market a little bit right now. When you see properties selling in Phoenix for 120, 125% a list, it's those guys coming in and flooding the market with cash. They're trying to get it to scale so they can form a REIT and use the REIT to refinance what they just purchased using debt. So their yields automatically go up. And I talked to one of the guys about that at a recent conference, and I said, so let me get this straight. You're knowingly going in overpaying, and you're going to finance this using leverage, which is going to improve your yields. Didn't we just go through this? Mm-hmm. And he said, yeah, but not on this scale. So I felt better after that.
Now, just to clarify, because a lot of us are not familiar with a REIT format, once that home goes into rental status and becomes part of that REIT, is it going to stay rental?
Yeah, it will stay rental.
Okay.
Well, but not forever. I mean, you can, depending on how you structure the REIT, you can ultimately sell off some of these properties.
Okay.
But you don't sell them off in large groups because you need the cash flow. The cash flow is what makes the REIT work. So you need a certain number of these properties in the REIT active at any point in time in order to make this happen. It's funny, people, and this is all new for me coming from Realty Track, where I used to count the number of houses in foreclosure. Now I'm dealing with structured financial products, and the SEC comes up and knocks on my door and says you can't talk about that. But it's a whole different model that we're looking at right now, and very different from an individual investor perspective, very different from what we're looking at doing. We have people talking about securities already. So now they're going to create new security products, And I've been saying to the press, you can't do that because there's no history. There's no track record of performance of nationally scaled single-family rental units and how they're going to perform. What's your vacancy rate? How much are you going to pay for maintenance? What does it cost you to manage properties, 38 properties in a given geography as opposed to 38 rental units in one facility? And there really isn't enough history to accurately gauge this, but I'm sure the rating agencies will come up with something that they stamp AAA, and then it'll all be safe. Well, it always works out that way. It
does, yeah. Do you recognize that, if not individually, collectively, you guys are market makers in a certain way?
I have been accused of, that's true. I believe what we're seeing right now from a pricing perspective is to a certain extent an investor-driven recovery.
Okay.
But the institutional investors can't take all the credit. We're not buying nearly as many properties as a group as individual investors are as a group. You still got us outnumbered out there. And that's a good thing. But yeah, when you go into a Phoenix, and Phoenix now got oversaturated, so you're seeing everybody run to Atlanta. And now we're starting to hear rumblings about people running to Las Vegas, which is really scary because the demographics, the market conditions are so different in that market than the other markets that it doesn't make any sense. Mm-hmm. But yeah, I mean, look, you've been talking about this all night. There are three different sources for properties that you can purchase. There's new home development, of which there's been virtually none over the last 5 years. There's existing home sales, which are limited because between a quarter and a third of all homeowners are upside down and don't want to or can't sell their property. And then there's distressed properties, which are technically existing homes, but we put them in a different bucket. And Sean can attest, we've seen foreclosure activity slow down to a crawl over the last couple of years. So all three of those are lower than normal. There's a limited amount of inventory available, and at that precise moment in time, Wall Street came in and said, hey, here's $8 billion, go spend it on REO properties.
With great care.
Well, look, we've only bought a few hundred properties at this point.
Yeah, you really have paced. As a matter of fact, are you wondering what to do with the rest of the money? And I'm sure you're finding something to do with it.
We are blessed by having a very patient investment partner who understands our model and our approach. And we've said, no, this is clearly a race the tortoise is going to win. We're not going to go out and overpay. We're not going to go out and underscore on yields. We're going to buy the properties that meet our model. And by the way, in a lot of cases, we're buying these from individual investors. And we're going to be in this for the long term.
What about bulk? I guess one of the misconceptions, and let's talk about that you're buying big pools of property that no one has access to, mm-hmm. or big node pools. So which one of those, if any, is true?
There's actually a syndicate in South America that puts together these on-the-side bulk deals nobody knows about. We're buying thousands of properties from some guy in Colombia. No. It's Columbia, South Carolina, in case you're checking. No, truth of the matter is I'd like everybody to hear this. There are no bulk sales. That's somebody from the California Association of Realtors over there. There's been so much hue and cry over how bad bulk sales are. Look, I'm not going to argue with anybody in the room. Mathematically, you can't make an argument that suggests that anybody should be selling properties off at bulk discounts right now. You just can't.
Right.
There's been one bulk sale from one of the GSEs through the FHFA. Slightly over 2,000 properties were announced in the sale. It took over a year to execute the sale. Not all of the deals have been done yet, okay? So in a year, we've probably seen almost 1,000 properties move. Okay, we're going to sell somewhere between 4.5 and 5 million properties this year. For anybody to get their knickers in a knot over 1,000 homes over that period of time is just, get a life, guys. You need a better hobby than to worry about this stuff. There's been one major bank that's conducted 2 bulk sales. Total number of properties included, 600. So there's a lot of discussion about this, but the bottom line is most of the institutional investors are out buying stuff off the MLS. They're buying it from individual or small investors who are selling off their pools at higher prices than what they paid. And in a couple cases, we're seeing some of the guys starting to go into trustee sales. We've opted not to do that at this point.
Okay.
But there are companies that are going into doing that. There really aren't any bulk sales.
What about note sales?
Note sales are a whole different model. And the reason for doing them and the methodology for how you handle them is very different. We have spent over $1 billion this year buying non-performing loans.
Aha.
Aha.
I caught you.
And the bad news for anybody waiting for REOs is that less than 20% of those loans will go to foreclosure.
Because the intent is to
this is
recast.
one of the few cases in our industry where everybody's interests are aligned. Our investors will actually get the best financial return if we're able to take a non-performing loan and modify it into a performing loan. The second best financial return is if we can convince the borrower, if they don't qualify for a modification or don't want to do a modification, and you'd be surprised how often we have that conversation, to do a short sale or a deed in lieu. So when we've exhausted every other alternative, we go to foreclosure, which is the worst financial return for us. There are some companies who aren't doing much business right now at a different model. It was buy the non-performing loan, immediately foreclose on the borrower, and then try and flip the property. That's not our model. And so again, over 80% of the properties involved in the note purchases we do either get modified or go out by way of short sale. Of the 20%, now we have another option. We didn't have this option a couple of years ago as an industry, but of that 20% that we do wind up foreclosing on, we'll take a look at the ones that might make sense for our rental markets. But you have to understand, when you buy a pool of non-performing loans, you don't get to select exactly which loans in exactly which markets. So not all those properties really fit that business model anyway. But it's a much better resolution for borrowers, for communities, for the housing market, because we're removing a lot of what would be distressed inventory, which keeps prices stabilized, and in a lot of cases keeps borrowers in their homes.
And it's really on a scale that we wouldn't be able to participate in anyway, because we would have to see multiple states within a day or two.
And that's the issue. I mean, we're buying properties in states with these pools that we wouldn't normally look at.
Okay.
When it takes you over 1,000 days to execute a foreclosure in New York, as an investor, you don't necessarily want to buy a property in New York. But if it's part of the pool, and it means you're going to get a bunch of properties in California or Texas or somewhere else, that's part of the deal, and you just deal with it.
Somebody's out there going, I think we can get rid of this New York one in this pool to Rick. It's good.
Not my money.
Sean, you have said long before it really has panned out to be true that you didn't think shadow inventory would end up crushing the market and being showing up in big quantities, but yet that rumor is still alive and well. We're still waiting for it. As a matter of fact, it's imminent, but now it's after the election.
Right. And if not after the election, after the first of the year.
There you go.
Okay. So
and if not after the first of the year, after Easter.
Okay.
Something.
Damn Easter bunny.
So what quantity, first of all, what do the banks own right now, and is it less than a year before, and is the pace likely to go up or down?
Yeah, so bank-owned inventory right now is around 64,000 units in California. That's about a 30% decline from a year ago. And it's taking the banks still on average about 9 months to sell that inventory, but it's less than 8 months worth of inventory. So I would say there's actually a shortage of REOs, and I think any REO agent can attest to that.
Does it look like the lenders are going to say, okay, well, now we can be aggressive and go after the people that are delinquent? Does that look like their model?
Well, you know, the problem is the model changed in September 2008. You know, when they announced TARP, everybody thought, and anybody who's heard me speak before has heard this before, but, you know, everybody thought it was about loans to the banks. And, you know, really what it was about at the end of the day was supporting the mortgage market, buying mortgage-backed securities. but also about not forcing banks to sell these properties at these quote-unquote distressed prices. And they just did two things. Before September 2008, if a home was 90, 120 days delinquent, depending on the regulatory agency, the bank had to foreclose, right? The regulators enforced that. And you had to move the thing through the process. And they changed the rules at that point in time. It was probably good, given that we were running out of money to bail out the banks. And the other thing that they did was, just in time for the banks to pass the solvency tests, they changed how banks had to account for these assets. And so instead of having to mark them down to their current market value, they could mark them to a model which theorized that most of these would pay off someday, and the losses were only 5%. In fact, most of the bank earning reports you've heard since then have been, when you hear positive earnings reports, when you dig into the numbers, it's usually gaming these loan loss reserves, and by lowering the loan loss reserves, they get to report positive earnings. So the bottom line, the game's completely changed. It's not in the bank's best interest to foreclose or even move these things through the process.
Just a short answer then on this question. Did you basically... No. No, he did good. No, this is...
No, I took all of his time. It's my fault.
No, I'm being honest. First of all, did you watch my presentation?
Absolutely.
Okay. Well, did you agree or disagree?
I agree, but, one of the things, the chart that you had that showed how much you were saving on payments versus rents was true in Riverside, San Bernardino.
Well, that's all I pointed out.
It wasn't true in Orange County. and I think, we're in different places in different parts of the market. I think Riverside, no question, overcorrected. And I also think that we now have a yield-driven market, not a comp-driven market.
Yeah. You know what I think is interesting, and this is what you do have to be aware of as an investor. You have an oversupply of buyers with an FHA qualifying loan limit, because if what I'm saying is true, they're emerging out of the they used to own it, they lost it, and now they can get an FHA loan. You have to be sure that that price range is inside that loan limit, or the demand's not there. And so in Riverside, you can't say, well, this $900,000 house is going to do really well. Well, no, it doesn't have a lot of buyers, because that's not where the bulk of the people are looking. And so that's a concern.
Do you agree with the FHA buyer thing? The one I did make a note in the
I
presentation.
saw your negative comment on that.
It wasn't a negative comment. Look, the average FHA loan has a FICO requirement today of 760.
No, not
yes,
FHA. No, that's
FHA.
No, that's Fannie Mae. I guarantee you. I know that number off, like the back of my hand. It really is.
I bet you $1.
But it's
There you go.
Okay. You saw it. Okay. Now I'll grant you, but I'll give you some numbers, because
all right. Let's assume it's 712. Okay. Was that your number?
No, but you owe me $1 then.
Okay.
Okay.
Will you take
anyway.
A check? Will you take a check? Anyway, but the point is, somebody who's gone through a foreclosure is not going to be up over a 700 FICO score in 2 to 3 years.
Well, that's what's interesting too.
But I think we're worrying about something. I don't think first-time buyers are driving this market. Investors are driving this market. And
that's because the first-time buyer doesn't get a chance to buy anything, but they're there.
Absolutely right. They're the ones submitting 24 offers and not ever getting to buy anything. So
I bet they have a
I don't think it
letter.
matters.
I think they have a pre-qual letter.
Yeah.
Okay.
Here's what just on the yield being more important than comps at this point. You think about Riverside, where you had the potential to get an ROI
We'll donate it.
of better than 10%. Well, if you think about, this isn't necessarily the rents in this area, but I'm going to use this math to keep it simple. You think $2,000 a month in rent, $4,000 a year in expenses, that's a $20,000 income stream. So think about this in terms of a fixed income investment, right? So at a 10% yield on a $20,000 income stream, that equals a $200,000 price. And that's kind of where we were, right? Mm-hmm. But now we've got the private equity firms coming in and buying at a 7 cap. They'll buy anything they can at a 7 cap, and they don't care what the comps are. Well, at a 7 cap, that same income stream is $285,000. And I think that explains a lot of what we've seen here in California. Now, there are plan, not Rick's, he's not doing this, Carrington's not doing this, but some of these guys' plans is to take this thing, package it into a REIT, and they're going to take the REIT out and float it with a 5% return. Right. So you do that math real quick, that's essentially a $400,000 value on the real estate. Now,
I'm going to frame this one, by the way.
You may do that.
But don't get too excited, because that $400,000 value in that REIT that that folks are going to invest in to get a good yield because they're buying into real estate when it's cheap and getting a fixed income return, all these people that don't want to own rentals, right? This is the way they're going to pitch these REITs. It's a $400,000 house, but it doesn't create a comp.
Right.
And I think that's the most interesting thing happening in housing right now. And I'm curious to see, versus your chart, how much of that is investor driven by yield in those places versus the other things. I think it all contributes, but I think that's a big part of it.
Was that a short answer? Anyway.
No.
It was a good answer.
One more question, and then we'll have everybody else come up if we could. The new foreclosure law in California, what did it change? And just fill us in on that.
You got to feel for the states. Banks are federally regulated, right? This game is played at a federal level, but states still control the foreclosure process. So they want to penalize banks, whether it's the state's attorney general or the legislature with these new laws, and they want to penalize these banks and they want to bring them to task for what they did. And the funny irony of the whole thing is really all they do is delay the whole process, which with banks now being servicers, benefits them. They get to continue to collect that servicing fee. And ultimately, they have kind of a super lien against the house, against the actual investor. So they get to collect all their fees. When that house is finally disposed of, whether it's today or 10 years from now, they get super priority. They get to collect everything. And, some of these investors are now finding out that, they thought maybe they lost 10 or 20% of their money, but, you have losses of 80, 90, 100% that have all been eaten up, not just by the downturn, but by all the fees through the servicing process.
I need to jump in there.
Go ahead.
Smaller, the specialty servicers, the ones who handle the processing of delinquent loans, in many cases are not banks, so they have to borrow money.
Right.
And a lot of those servicers have taken a huge hit on the cost of borrowing money, even though they do have a super lien position. So while you're making those advanced payments, what people don't realize, most people, is servicers are required to make the payments on behalf of the borrower who's not making the payments. And the more money you have to borrow in order to do that, the more likely it is you're not going to be able to recover all of your losses over a long period of time.
Which is why it's good to be a bank and
Why it's
have
great to be a bank.
Uncle Federal Reserve making money free.
The other big issue with the California Homeowners Bill of Rights isn't so much the prescriptive requirements.
Exactly when did I lose control of this? Go ahead.
That's why I gave you the dollar. It's a lot of those prescriptive requirements are required by HAMP already, and a lot of them were in the AG settlement. So if you're a HAMP shop, you're doing a lot of that stuff anyway.
Specifically that. I mean, the state said we're going to enact the Attorney General settlement.
The big aha in that bill is that it gives the individual homeowner the opportunity to pursue litigation against the lender and the servicer. And there's a little clause in there that stipulates that the lender and servicer are on the hook for court costs no matter who prevails. Wow. So that, everybody got that one. I like that. That's good. So that really is the shadow of that particular piece of legislation. And if it's not corrected, I think it's going to make mortgages more expensive to get in California.
Okay.
And that is still the next wave of this is the legal phase, right? The winners will be the ultimate, the winners here will ultimately be lawyers.
The lawyers.
Who make the rules.
Maybe I'd sit next to you so we can talk about releasing reserves, but
all right.
Okay. You guys were kind enough to fill out a questionnaire, and so some of what I'm about to do is ask questions that had something to do with what you were concerned about. by show of hands, how many people are concerned about the fiscal cliff issues of our country? Almost nobody. No, I can't see. The light's too bright. Okay. So I'm just going to open it up. This is a quote from Bernanke. If the fiscal cliff isn't addressed, I don't think our tools are strong enough to offset the effects of a major financial shock. So I guess the opening question, and let anybody start, are we taking this seriously? We haven't heard from Eric and Wally. Why don't you start it?
Sure.
And yeah, Mike, kind of get close.
Grab the mic.
Yeah.
Well, so the Congressional Budget Office came up with a number for the Fed to go out and talk about. There's 4% of GDP. So if all these tax laws expire and blah, 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 then by the first quarter of 2013, we have a negative 4% of GDP effect. And given that we're running at about 2% of GDP, obviously that would send us into recession. So it's really a message for Congress, don't do that.
Okay.
The bond markets, near as I can tell, don't think it's going to happen because they haven't moved. I would only say that if somehow Congress did manage to fumble the ball across into 2013, it would be some kind of disaster. But it would be kind of a third world event for us. So I don't think it's very high probability.
Any other comments? I mean, I thought we were actually going to take it seriously, and you're saying it's mathematically absolutely certain we can't.
Right, we can't.
We can't.
So we won't.
We're in so much debt we can't.
We
can't stop building debt at this point, and it's because of the timing of it. We already are. That output gap is a problem.
Look, we have a bond market. The last time we fumbled it, the bond market was about $800 billion. That was in the mid-1970s, and it was a very small default, very small mistake, and it sent yields up, I think, about 30 basis points across the entire yield curve, and they never came down again. So bond markets are very unforgiving about these kinds of mistakes. So if we were to make a mistake on that scale, remember now we have a $37 trillion bond market, it would have obviously a much larger impact.
I was going to add two things to that, and one is that you remember maybe 2 summers ago, it seems really a long time ago, we had the debt ceiling debacle, and consumer confidence reacted really negatively to that, even more so than investors. And at least what one sort of hears from people who try to stay in touch with what's going on in legislators' minds is that lesson seems to have sunk in. So I think that's one reason that the bond market is not as anxious about this as one might think. But the second more important point I think around this is that it really highlights what Bernanke's frustrations are in the sense that, and the frustrations for a lot of economists in the sense that we just have massive fiscal problems. We basically have we've promised people all sorts of things that just don't add up. And eventually some of those promises aren't going to be kept. And among adults here in the room, we all wish we could, in some reasonable way, manage that process and get to the point where we get on a much more sustainable fiscal path. But, it's going to continue to be a problem. We got the fiscal cliff now. You'll have another debt ceiling coming up eventually again. There's a real need to come up with some sort of budget deal. There's a need to deal with the fact that we have an aging population. We got the baby boomers. I mean, all this stuff is well known, but we just need to deal with it.
I think we need to ask China for a principal balance reduction.
Good idea. The Fed's message is Congress, you guys need to work on this fiscal problem, but not now, because now we're in an output gap, so you guys got to keep pouring it on. And of course, in Japan, they've been doing this now for going on 20 years. So when does the not now happen, right? So that's always been the challenge.
Isn't there an expectation that it's actually going to get taken seriously by others? Let's say, you guys have kind of informed me of it's different than I thought it was. I actually thought, I really did. I thought we were going to solve this somehow, and I thought we were going to have okay, let's generate more revenue this way, let's cut back here, and let's at least do some of what we're supposed to do. Now you're leading me to believe.
Have you been paying any attention at all to this election? Any?
Well, you know, what's amazing, though, is we better show up have a leader at some point that has maybe the guts and the ability to say, guys, we are not going to keep all of our promises. It's more honorable to let us know now than later.
Okay, and absolutely. And that person is?
Well, I know, that person hasn't shown up yet, apparently.
That's the problem. So if you ask any of the candidates right now, there could be general agreement in principle that we need to cut something. We start going down the list. That's
Okay,
the problem.
well, and that's one of the reasons why this meeting's important, because something that's on the list would be real estate. I mean, real estate to me is the low-hanging fruit, in a way.
Like the mortgage deduction, interest
Well,
deduction.
mortgage deduction, especially when you get 3% interest. I mean, honestly, how many people are going to have a deductible interest when they have a $300,000 loan and it's a 3% mortgage? Not if you're a married couple, so you could deduct it. I don't even know if it'd be revenue generating.
That's a good point.
Yeah, but what about, I mean, I'm not trying to take all the goodies away, but if you had to offer some, how did we ever get the $500,000 free sale every other year for our asset? I mean, that
was Clinton's gift.
That was an amazing thing. I remember calling up Robert Bruss when I heard that, and I went, I haven't got that right? Every other year? Okay, is that something that, couldn't that be taken, and would it even be defendable? No, we really need that.
It cracks me up that, you know, when we went back and spoke to Fannie and HUD, you know, one of the things that they were talking about is, well, boy, how do we separate out, because we were there asking for more loans for investors, and they said, well, how do we separate out investors from speculators? And because we don't want to give loans to speculators, but we're okay with real investors. And I'm thinking, you know, $500K every 2 years, on the one hand, you want everybody to be a speculator, right? Because that's what that law basically said. And then on the other hand, but yeah, we don't want anything to do with them.
Well, I mean, it also benefits who? It has to be a coastal state in a boom. So it doesn't, I mean, it couldn't possibly benefit 45 states, let's say, and very few of the 5 would be cashing in now every 10 years instead of every 2. Anyway, are we seriously, you collectively, or you're telling me we don't have to worry of any goodies getting taken away from real estate, and we're going to completely ignore the fiscal cliff, and we'll see you the next election?
Those are two separate questions.
Okay.
No, they really are.
I'm not going to pay you $1 for
just looking at the body language up here at the table.
Yeah?
I think we're all kind of the opinion that we will not fall off the fiscal cliff. Okay? Some miracle will happen in January or February, and amazingly we'll figure out a way to get around that. But that doesn't mean that some goodies aren't going to come out of the goodie bag. I think anybody in here who makes a measurable income is in trouble.
Well, you know, by the way,
I do think that the mortgage deduction is probably very vulnerable right now, at least at some level. But it's hard to speculate right now because the election is too close to call in most polls, and I really do believe you'll have 2 very different philosophies in terms of how higher income taxpayers are treated depending on who comes into office. So if the current administration comes into office, I think that tax deduction is dead. I think there are probably going to be higher taxes, which are going to limit investment opportunities. If the other guy gets in, I don't know exactly what the policies are, but I suspect it'll be a little bit more lenient toward the higher end. So you're asking a question to an answer. You're asking an answer for a question. The question is moving right now. So it's really hard to pin it down and say this is where it's going to go.
So one way to frame this is to think about what would be the principle, the underlying principle that would be used to decide what gets cut. So you're going right to what is the most politically vulnerable would be the first thing to get cut. And you're thinking the mortgage interest deduction is probably top of the list. It did come up in the debates, which is unusual. Yeah. So it does stand out. But the reality is that in a much broader perspective, that principle aside, the minute we started to allow, I mean, government debt is nothing more than tomorrow's taxes plus interest. And the minute we allowed politicians to bribe us with their own money in this way without putting any limits on it is where we started to get into this trouble. And the only way out of it is to reverse that process. and not have the decisions made on the principle of who has the strongest lobbies and who has the weakest lobbies. It's got to be based on the
And that's not
principle,
going to
what's
happen
best
this
for the
election.
companies.
Is it already in place that there's going to be a 3.8% tax increase for 250 and above for interest and dividends? I mean, isn't that already in place if Obamacare goes forward?
It's already in place.
It's already in place, and
It starts January 1st.
That's right. I don't know why that's not mentioned, because we're really saying that we got to tax the rich more or whatever. Well, if you're rich at 250, it's already in place for next year, 3.8% added. Why hasn't that been mentioned? It's like they forgot or they don't, it doesn't count.
Nobody recognizes it until it hits them.
Okay. Now, I mean, the interest rate deduction is almost like the holy grail of real estate.
Correct.
Okay. So you think, what you said, I think, is you think they could go down to, say, 500,000 or something to say vary the amount of the deduction?
I think you're going to wind up with a variable deduction. It'll, at a certain, it's going to be capped at a certain level, and underneath that, you'll have some sort of tiered structure. That's, me with my extensive background in politics. That's what I think is most likely to happen.
I think that's right.
If you think about it, though, right, I don't think it has much impact on most, residential neighborhoods. Where it's going to have an impact is on yacht sales and second homes in second home neighborhoods, right? Because that's actually where the second home or the mortgage interest deduction becomes pretty useful. So as you start thinking about where might it have an impact, I don't think it's going to, if it went away, does it have any impact on me as an investor in Riverside? I don't think so.
But it does change the variable a little bit in terms of looking at that rent versus buy variable, because suddenly one of your benefits of buying becomes a little weaker.
At 3% with a $50,000 income, when most people under a $50,000 income don't pay federal taxes anyways.
So for your first-time home buyer who's in the 53% or 47%, depending on whose numbers you look at, it's a non-factor.
Right.
But they don't buy yachts.
No. That's why I'm saying it's bad for yachts.
Okay. How about?
And actually, if you look at the numbers on second homes, it's not going to raise that much revenue if it's eliminated on second home.
Oh, this is purely posturing.
Absolutely, it is.
The revenue
Absolutely
being
it
raised will pay for about 14 seconds of the government costs. I mean, it's
That's exactly right.
Yeah.
that's an estimate. It could be 15 seconds.
Okay. I won't hold you to that. Do you think, what about capital gains? That's kind of important to this group. Capital gains tax increase?
I don't see it under either administration changing.
Don't see it either, okay. I'm really surprised. I thought we would probably see a lot of changes because we actually have to see them. And now I'm being told we really need to see them, but we're not going to do them. And so there. I mean, that scares me. We're going to push it down. We're going to, how far? This road is really long, man. This can has been on this road for a while. But doesn't the solution, I'm being a citizen, doesn't the solution start becoming a lot more painful for the next generation?
Sure.
Well, when do we go, let's don't do that? That kind of drives me crazy.
You're in a state, you're in the only state in the union that put back into office virtually every assembly person and senator in the last election. A state that has, what, a $20 billion budget deficit? And you're asking us why we're not doing something about it?
Okay, let's talk about Chapter 19 bankruptcy.
And you guys can't print money.
Yeah.
Well, no, we really can't. All right, let's talk about Chapter 19 bankruptcy. Is that the number? I think it is. I've studied it, and I'm a little tired, as you can imagine. So, but
9, right?
Chapter 9. Thanks. I added a 1. I'm glad you didn't bet me. I'd have lost $1. Okay, is that a serious? Well, first of all, it's a serious problem to have a big deficit that you really maybe keep on going down that road. But Chapter 9 bankruptcy, from what I've seen, doesn't solve the biggest problem. Is that because, you know, the retirement dollars of CalPERS and stuff is sort of an untouchable item. Is that true? Is anybody knowledgeable enough to go, yeah, that's kind of true?
Well, you know, I'm not an expert on this, but, you know, I know like in Vallejo and some of the places that have gone through this already, you know, it's cleared up some of the debt, but it hasn't cleared up the unfunded pension liabilities, right? So there's still this huge, you know, problem that hasn't yet been faced. And, you know, that's clearly going to continue to be an issue for cities in California, because we've got an awful lot of cities, you know, on the brink.
Well, and what it has changed is they very often don't show up first to their fires. They have other companies from other cities beat them to it because they have so few. They might be busy with one thing and they can't get to another.
You know, one of the things that really bothers me when I hear it, you know, is around the foreclosures cause price declines. But, you know, in my little hometown of Discovery Bay, they closed down the local fire department that's been there for, you know, since the place started 30 years ago. And, you know, they said they had to close it down because, you know, they'd lost so much revenue. The only problem with that is they have more revenue today than they had before the bubble. You know, revenues increased at better than rates of inflation. And, you know, what happened during the bubble is our cities and county and the states, instead of taking that revenue as this big one-time windfall, which is what it was, is they went out and spent it like it was going to continue coming forever. And that largely happened in, you know, pensions and benefits and you know, public sector pay. And it's really hard to put that genie back in the hat, but we're now losing fire departments when there's more revenue than they had before because there's not enough revenue. And, you know, there's a structural problem there that, you know, we let some of these things advance way faster than they should have. At some point, we're going to have to recognize that and deal with it. In the meantime, you know, I think it's going to get worse before it gets better.
But the high-speed rail line, we can get the fire department from Orange County up to Discovery Bay. That's it. And so you're all covered.
Right. Well, just it going by so fast will put out the fire.
It'll suck the fire right out.
Yeah.
Yeah.
Now, they're not taking this very seriously, are they?
It's gallows humor.
It is gallows humor.
You know all those task force where the Democrats and the Republicans worked for months and they came up with a document that I took the time to read with the yellow marker. That's a meaningless document. None of that is even going to get contemplated. It was just like a perfunctory.
Yeah.
Yeah?
Yeah.
Wow.
Well, I mean, one of the areas, you know, we think about government growing over the last, 30 years. Federal government, in terms of employment, has been shrinking. Actually, it's been pretty flat for the last 30 years, but it's gone from about 33% to about 13% of total government employment since the 1930s. It's been shrinking, actually, since the 1970s. The huge area of growth is in local government. And this gets back to Sean's point about, you know, we've all become accustomed to a pretty high level of service in our towns, and it's expensive. We have all these people to pay and all their pensions to pay. The other thing that happened is that all these towns got talked into taking out all these bonds. So you might have no fire department, but you probably have a really nice fire building,
Right.
you know, where they used to be.
Jeez.
Yeah.
And, you know, there's a reason why municipal bonds have such a lower default rate than corporate bonds. It's because towns can always go find the money to pay the bonds, even if they can't find the money to pay the fire department.
Go ahead.
I was going to add on that local government question is that, you know, and I don't know, you don't live in California, but one thing you might want to look at when you're trying to judge these things is take a look whether it's a local, state, and police, you know, retirement system or the whole state or anything else. Take a look at what their assumptions are about their rates of return that they're using to discount those future liabilities. And, you know, one of the looming things, so there's two things to look at. One is to look at how underfunded the plan is, but don't just stop looking at that. Also take a look at their assumptions, because if they're assuming 8 or 9% growth rate in investments and, you know, under pension accounting rules for corporate entities. They can't assume anything like that much. So we have a little bit of that old dynamic that some of us remember where from the 80s where there's different accounting rules in some cases. And so I think some of those assumptions that states and municipalities are making about returns are another place where you're going to see problems.
EJ, you had mentioned that to me when I was talking to you on the radio, that it's good for us when we have borrowed money against real estate, but it's really on the other side of the coin, the person that saved all their life is trying to get a yield on it. And now you have CalPERS, let's say the 12-month return for them, I'm sure it was projected that it needed to be, what, 7 or 8% to make their nut, so to speak, and it was 1. That's a problem.
It's a huge problem. And it, that is the flip side of this low interest rate environment. That savers you were just taking money out of the savers and taking it over and putting it in somebody else's pocket. And it is making this pension issue, which is huge, not only for state and local government, but it's also huge for certain corporations and other organizations that have legacy pension plans. That, they can't earn enough to pay their participants who are living longer than they assumed even in the beginning.
So it's a mathematical certainty we're not paying people that we've made promises to, right?
Right, yeah.
Yeah. Wouldn't it be good that we tell them sort of early? I mean, honestly, who's going to go for the plan that go, let's don't tell them until like the end when they've got no chance to make the money up and they'll be homeless. I don't get the plan, and I'm frustrated. I really thought we were going to take, not this panel, but I actually thought we were going to end up having something happen after the election where Democrats and Republicans are going, okay, let's knock this off for the next 60 days, and we got to do something that's right. And wow, I'm surprised, but you guys are, I'm so gullible. I think people are actually going to do this stuff. Okay, we've almost run out of time, but there was a couple of things I did want to ask. Commercial real estate, and I really don't know the answer to this one, but I know that there's a ton of debt that's about to have, it's coming due. And
Retail.
Pardon me?
Retail, particular office?
All of the above. I mean, say $1.5 trillion of debt in the next 4 years where the maturity date happens, and that's the worst of the worst loan. It was made at the peak of the market, so it probably has the least teeth originally. And I wanted to know, first of all, is that going to cause a lot of losses in the mortgage, like the equivalent to the mortgage-backed security world for residential? Is it going to do that because people have collateralized debt obligations and other people have credit default swap bets against that? Is that arranged the same way? Does anybody know? EJ, I know you were involved in that world, and I know you.
Right. Well, first of all, just because a loan matures,
yes,
doesn't cause a loss.
Right. Okay.
So, what I think is good. First of all, if you look at the commercial equivalent of the residential mortgage-backed market, it's about $700 billion, and it's actually been shrinking at the rate of about roughly $100 billion a year over the last couple of years through a combination of refinancing and paying off and people taking losses.
Right.
And the big maturity bubble, if you will, is actually about 2 years out.
Right.
And I think it's the number itself is pretty manageable. When you talk about trillions of dollars of maturities, the bulk of that is actually sitting in the banks. And contrary to maybe some other people's opinions, the banks are actually in pretty good shape. Roughly 85% of the banking assets in the United States are held by the top 25 banks.
Okay.
And those top 25 banks have shrunk their real estate at a pretty rapid pace. Now, our bank is a little different than most, but since '07, our commercial real estate has dropped from $16.5 billion to $11 billion. And
Okay.
so I personally don't think it's the kind of, you know, Armageddon that you know, you read about in the press.
Okay. Appreciate that.
But I'd love to hear an alternative opinion.
I'm not knowledgeable enough to give one. I'm watching auction.com auction off the notes at a discount. I figure they're in business because some lender can't get what they're owed. And there's a listing next door to a building that I bought that was bought for $950 plus, and I bought it for $319, and a lender just took back a $3.6 million loan that they haven't been getting paid on for a while, and they listed it at 1.5. So I'm just physically seeing. That'll put a dent in your balance sheet there, you know.
Well, but you don't know if that dent was incurred the day that, it doesn't necessarily occur the day that they put that note out. You know, I mean, you know, Sean, you mentioned, you know, reserves. I mean, in '08 and '09 and '10, banks built enormous reserves, you know, and that's frankly why we had, you know, part of the reason we had TARP, part of the reason we had the stress test. You know, and after the stress test, banks had to go out and raise a whole bunch of equity, and so a lot of the accounting for that is you build the reserve up. When you sell the note, you charge it down, and you pull that out of the reserve. So a lot of those losses were actually recognized in '08, '09, and '10.
Okay.
I think that's a really important point. You know, you showed all of that negative equity, you know, in the chart, and all the negative equity reports you see from CoreLogic. And I think one thing that's really important to understand is that negative equity sits on homeowners' balance sheets, but a lot of that's been written down on the bank's balance sheets, right? So when the bank writes that loan down, you know, the homeowner doesn't get that reduction, right? And, you know, so this translates into our day-to-day life, right? You see a neighbor that gets principal balance modification, and it cuts their principal in half. And you talk to them, and it turns out they had a pay option arm, worst of the worst loan. But it makes perfect sense because that loan traded for pennies on the dollars years ago, and the person that just gave them a principal balance reduction just recognized a huge gain because they actually reduced it to an amount more than what they bought it for. And it's now performing again. So that big negative equity number sits on homeowners still, and I think it hurts the economy because the economy is consumer driven, but it's not necessarily a problem at the banks to the same degree.
Okay. Let's just do one question, one answer for everybody. We'll start on my right, and I'm just trying to think of the right pessimist or optimist for the next 12 months for our industry, and a short reason why.
Well, I'm extremely optimistic, and maybe that's just my nature, but I think we've actually seen the worst of the times for us. I think moving forward, unless the fiscal cliff we fall off of.
No one cares.
Which I don't think that's going to no, I don't think that's going to happen. And so I think we're poised for good growth, not, you know, extreme growth, but good growth. Okay. So I'm positive on it.
So overall, I'm optimistic about real estate, especially with a decent return on investment. That matters a lot more to me than comps. And, you know, the one thing is I do believe in that theory of a black swan or unexpected events. And I think we have real structural problems, and the likelihood of maybe not the fiscal cliff, but something coming that's bad, I think is still a real possibility. So I'm bearish, or, you know, I'm not that optimistic overall in terms of, I think we have some rough days ahead for the economy. But if I think about where I want my money to actually be, I want it to be in real assets that I think I can get a real return on, and that's probably real estate, among maybe a couple of others.
We're going to skip Rick. Oh. Go right ahead.
I'm more optimistic than pessimistic, but within a certain context. I think we're in for what I would call a sawtooth recovery. We're probably a year away from having inventory levels for properties that feel not like we're in a period of oversupply, but between foreclosures starting up again in a lot of parts of the country and new home builders starting up again. I think at some point we're going to see enough supply that prices go back down a little bit, and it's going to take us a couple of years to work through the backlog of distressed inventory that we have. To Sean's point, the economy is still relatively weak. Historically, what I've been able to determine is that until you see unemployment rates getting down somewhere between 6 to 6.5%, you're not going to see a huge upswing in terms of home purchasing. So I think it's going to take us a couple of years, again, to work our way through that until unemployment rates come back down. The way I phrased it to somebody earlier today is that the housing market is in recovery, but it's much like a patient who's been in intensive care for the last few years. So feeling better, but not quite ready to run a triathlon.
Okay. Sarah?
I too am fairly optimistic. I think that we're seeing returns finally on investment in real estate. I think that moving forward, the months following the election are going to be extremely critical in terms of investor attitude and how people will choose to move forward. And I think that depending on the person who is elected, my optimism may shrink a bit. But
we've been so politically correct. That's great.
I would hope that moving forward we can see more growth. I think that the maturation of the baby boomers is certainly something that's out there. I think it's going to be an extreme effect on the housing market as we see people looking for a different kind of lifestyle, a different place, and being able to afford that kind of lifestyle with the kind of investment that they need to make in the economy and the kind of investment they need to make to keep them moving and viable, and to keep the economy viable.
Well, we just went through a pretty traumatic experience, right? We had a epic bubble in a core aspect of our economy in residential real estate. It's been very, very important to our economy now for well over 30 years. And it became the epicenter of this gigantic pricing credit distortion. And it's only been recovering now for about 6 years. I think expecting it to recover in only 6 years is a lot to expect. And this is happening with the federal government and the Federal Reserve throwing everything in the kitchen sink at it. So if they continue to do that, I think we'll see the same rate of recovery that we're seeing, which is starting to feel a lot better than it has before. But I think the fundamental question is, can we afford to continue to maintain this level of support for the industry? We have an economy which is like an airplane running at close to stall speed, very vulnerable to a shock, as Sean was pointing out. So I think those are our challenges, that we have to maintain this level of support, even to continue the level of recovery that we're getting, and we're vulnerable to shocks, fiscal cliff, oil price shock, a number of things. So I'd like to be optimistic, but I think we put ourselves in a very vulnerable spot.
So, it's optimism is relative, right? So, given what we've all gotten used to, I say I'd be guardedly optimistic. I mean, we have all the long list of things that could go wrong. We do see employment very slowly, gradually improving, and really, to me, that's the key thing. The thing that worries me the most is probably that one of the things that has worked reasonably well has been a big improvement in exports, and I don't know if we're going to be able to sustain that. Europe's now in recession. Asia, it's hard to tell exactly what's going on, but some people say it's slowing down considerably. And we're still a big commodity exporter. We're still a big agricultural exporter. We're still a big energy producer. So, I worry about when you're trying to grow an economy by using productivity improvement rather than adding leverage, it just strikes me as a much slower rate of growth, right? because you got to have managerial, technical innovation has to drive the growth rather than just adding leverage. So, yeah, I think we're going to grow. We probably won't go into another recession, but it's not going to be any great, fantastic growth rate. And ultimately, you need employment to hold up real estate prices.
Well, the beauty of being the last person on the panel is I get to say I agree with everything everybody else said. But I, too, am optimistic, and it is because I have very low expectations. And if you've charged off as much as I have since '07, the fact that I'm only charging this much off today makes me very happy. Some of my options may actually be back in the money next year. No, but I am cautiously optimistic like the rest of the panel. I think it is a slow recovery, and I think we all need to expect that we have a few more years of slow growth.
I want to thank all of you. It's been, to me, a special night with some special characters. Thank you very, very much. Thank you, guys.